All right. It is the third week of our webinar, our Generational Wealth series, where we are maximizing real estate as a tool, as an investment towards generational wealth. So today is week 3. We have one more week to go, which I'm super excited. And I want to thank every single lady that has been rocking with me, Kathleen Barreau, your favorite realtor, your favorite mortgage broker, and we're going to go ahead and get into it. Time is of the essence, so I'm going to go ahead and get into it because there's so much for us to cover. So I'm going to go ahead and share my screen with you, beautiful souls. So let's go ahead and get into it. Let's do it. All right. Okay, so today's class is called Extracting Wealth Using Equity to Scale. What exactly does that mean? It's a strategic guide to helping women get ready to move beyond homeownership into a real wealth building through real estate equity. So let's go ahead and get into it. All right, so in my first class, if you guys attended, or you ladies, I have to really stop saying that. If you ladies attended my very first class, I talked about what exactly is equity. So equity is the difference between what your home is worth versus what you still owe. But it's more than just a number on a statement. It's liquid potential wealth waiting to be activated. Every mortgage payment you make, every market appreciation cycle, every improvement you invest into your property builds a higher number. So the simple formula for knowing what your equity is you take the home value minus the mortgage balance, and that totals your equity. So in real numbers, $450,000 is the home value. Your loan balance is $280,000. So therefore, you have $170,000 in equity. So why exactly does that matter to you? It matters to you because equity can be converted into capital without you ever having to sell your home. So you can have that home for 10 years, 15 years, 20 years, and you still have access to the equity. You can still tap into it for whatever expenses you need for your generational wealth, for your future, for home improvements, for buy downs. It also matters to you because it grows passively as market appreciates and the loan you is being paid down. Another thing is it is the foundational lever for scaling a real estate portfolio. And lastly, most homeowners sit on it for decades without it ever being in use. So that's exactly why it matters to you. Now let's go and move forward. We're going to talk about two tools, your cash out refinance versus your HELOC. So you have two very, very powerful tools, same source, but totally different mechanics. So you're choosing the right one depends on your goals, timeline, and your risk tolerance. And I'm here to help you understand what each of them means to you so you know when to pull the trigger. All right, so let's talk about your cash out refinance. So the cash out refinance replaces your total existing mortgage with a new one, a larger one. Because remember, you had your balance, and now that you're doing a cash out refinance, you're adding the equity on top of your existing. Now, you do pocket the difference as cash. You do have a fixed interest rate, which is you have predictable monthly payments, so you know exactly what you're going to get paid. You're going to pay, excuse me, every single month. Your principal, your interest, your taxes, and insurance. In some cases, your association. And it is best to use it when the current market is favorable. So you know that you're going to have a really good interest rate. So like, let's say that you're doing a cash out refinance and you might have a pretty good interest rate. You don't want to do a cash out knowing that you're going to pay almost 1.5% to double the interest rate. You want to make sure that you're entering the market when interest rates are really good. So you want to get in there when the interest rates are in your favor. And then lastly, your closing costs are going to average about 2 to 5% of the loan. So this is ideal for lump sum investments. So if you already know that you're going to buy a property outright cash and there's no loan, then I would definitely recommend a cash out refinance and not a HELOC. Um, and again, if the property is within the reach of your equity, that you're going to go ahead and get in a lump sum, you want to go ahead and use that, buy that property outright, because with that property, you wouldn't have to pay a mortgage on it. Now, I would deviate for what I'm saying if you are buying a multifamily that is 5 to 8 units, and that down payment is a sizable amount, and that 5 to 8 unit can generate you a significant amount of cash flow every single month. So I would definitely encourage you to go ahead and do that cash out refi. Now, HELOC. The HELOCs are a revolving line of credit. It is secured again by your home equity. You only draw what you need. You do not take a whole lump sum as the cash out refi that we talked about. The interest rate is variable. It does tie to the market. When I say the market is it's tied to the stock market. So we do know that the stock market changes every single month. It changes throughout the day, depending on how hello, Miss Beverly. Hello, hello, hello. We started.
Hi. Sorry.
No worries. Welcome to the class. So we did start. So we're just talking
Okay.
about cash out refinances. We're talking about the difference between them. We said that the cash out refinances, that replaces your existing mortgage, and it replaces what your current mortgage is with a totally new one. So what that means is that whatever your current mortgage is going to be a larger one, because you're now adding on top of what your balance was for the previous loan to the equity that you took out. So just to reiterate, today's class is called Extracting Your Equity, to use that in financing your next investment. So we're going to go ahead and move along. So with the cash out refinance, you do have a fixed rate. The monthly payments that you're paying is predictable every single month for the next 30 years, unless you refinance or you sell the property. This is best used when the rates are favorable. So you do not want to use this, you don't want to get a cash out refinance if interest rates are bad, unless you totally know what your exit strategy is. But if you know that you're going to go in and you're going to pay like 1% to 1.5 more than what you're currently paying, then maybe it's best to sit out. And then you also want to only use that if you know that you're going to buy something considerably significant to your cash flow, if it is a multifamily of 4 units or more. So, and then also I want to point out that your closing cost is somewhere between 2% to 5% of the loan. So that is how cash out refinances work. So cash out refinances are good for large lump sum investments. So if you know that you found a great deal, a distressed property that, let's say, it's under $100,000, and you're like, oh my gosh, this is a steal. The square footage is there. It's located in an ideal market, that the market is, or the neighborhood or the market area is trending, meaning that people want to live in that area. There's great schools. There's traffic there. There's economic growth there. That is where you definitely want to invest in. So that is the gist of cash out refinances. Now, HELOCs. Works just like a credit card. It's like a revolving line of credit. So you only use what you need. You do not take the whole amount like a cash out refinance. You only take what you need. The variable rate, it's what it means, variable. It means it fluctuates with the market. The market is the stock market. So HELOCs are tied with the stock market. So if the market goes up, the interest rate on the HELOC goes up. If the market is going great, then your interest rate will go down. So again, it's tied to the stock market, and it's not fixed. It varies, or it's variable depending on how the market flows from day to day, from month to month. Now, when I say from day to day, your interest rate, because you only make one payment for the month, you're going to see the changes monthly, not daily. Now, with HELOCs, you guys are only paying interest only payments. You're not paying towards your principal. You're only paying interest only. Now, this works if you want to keep your monthly payments low, and you're not paying towards the principal, and you have an exit strategy. And so you're only paying you. Hello, Miss Tanisha. Thank you for joining the class. So we're going deeper into extracting equity. So we talked about cash out refinances. With cash out refis, it replaces your existing mortgage, layering the equity that you're putting on top of the mortgage. You pocket the difference as a cash. Your interest rate is fixed for the next 30 years unless you refinance again or you sell the property. And then it is best to use it when the market or when the interest rates are favorable. When I say favorable, it means that you're cashing out. If you're going to do a cash out refi, you want to make sure that the interest rate benefits you. You're not going to go into another interest rate that is 1.5% to 2% more than what you're currently paying for, unless you have an exit strategy. And then lastly, your closing cost is anywhere between 2% to 5%. Now, HELOCs works just like a credit card. You only take what you need. You don't take the whole lump sum like a cash out refi. Now, with the HELOC, it is not a fixed rate. It's variable. So it changes every single month because it is tied to the stock market. And
Yeesh.
hello? Oh, okay.
Yes.
Okay. So, and then you're only paying interest only on it. So if you're looking to keep your monthly low, it's only going to pay IO or interest only during the course of the draw period. So whatever you took out of that, that's what you're paying for it. Now, once you're done paying your draw, you're not paying anything, but then once you redraw on it, because let's say the roof collapsed because the roof needed to be replaced and you didn't replace it at a decent time, then you're subject to whatever the interest rate is for that current time. Now the next thing is your lower upfront cost is a lot less than a refinance. You're going to pay a lot less than that. You're going to pay like a couple of thousands of dollars, and then they're going to dock that or deduct that from your closing costs. So let us go ahead and move on. When do you pull equity and when should you wait? So when you access equity, the timing and the purpose, it all matters enormously. So pulling equity is strategically can accelerate your portfolio, but if you do not pull it at the right time, it can be reckless. So when you pull your equity out, you pull it when you see that your property is producing equity, when you know that it's going to be income producing and you see that it's been identified. Secondly, the return on your investment exceeds what you borrowed. Third, you want to maintain 20% or more equity in your primary home after the withdrawal. Sorry about that. So after you pull the equity out of your home, you want to at least have at least 20% left of the equity in your home. So in the event that it's used as a cushion, so in the event that you need to return, the threshold is already there, and then you'll have more money on top of that 20% when you decide to go back for more. Now, your debt to income ratio remains lender friendly. That's when you know when you want to pull out. Now, when I spoke in the previous courses, I told you ladies that your debt to income ratio is the debt going out, meaning your credit cards, your mortgage, your car notes. Though any total micro loans that's on your credit history, that is your debt versus the income coming in. Whether you ladies are W-2, you're 1099, you're receiving child support, Social Security, pension, those are verifiable income. And lastly, you want to have 6 months reserves post deployment. So in the event that something happens, you at least have the money there to know that you're safe for the next year and half a year to pay your mortgage, your principal, interest, taxes, and insurance, in some cases, association. Now, when should you not pull? You shouldn't pull when you don't have any deployment plan for the funds. So you pull this money. What exactly are you going to do with it? If you don't have a clear plan and you just are sitting on this money, you don't want to pull the money out because the bank is expecting you to pay this mortgage every single month, despite whatever your plans are, because the bank is in business to make money. We all are. Next up, you're covering personal expenses of lifestyle, like inflations. You're not using the money to buy yourself a new car. You're not borrowing this money to pay this lavish lifestyle. The whole point of you borrowing this money is to either invest in another property or for improvements. Now, the next one is your market conditions. How highly uncertain are they, or and is your income stable or unstable? If your income, you know your income is not stable, you make large sums of money 1 month, but 2 months later you make a larger amount. That's not going to work because the lender expects to see their money every single month, not bi-monthly every single month. So if you know that you don't have stable income, this is not the time to enter the market to do a HELOC or a cash out refi. And also, you don't want to do that if the conditions are uncertain. When I say the conditions are uncertain, okay, so how is the market going? Do you see that the economy is starting to weaken? Are you seeing that the growth in the neighborhood of where your home is located is starting to decline? Those are things that you want to look into because that all pays attention or it all factors, excuse me, it all factors into the economy. It all factors into um, how your everyday expenses take a toll. So those are the things that you want to look into: stability of your income and stability of the immediate economic economy that you're living in. Next up is you haven't stress test the numbers on the investment. I'm going to go over that in a little bit. I'm going to give you an example of how to do the numbers, to run the numbers when it is time for when you're ready to go ahead and do an investment. And then last, you would be left with less than 6 months of emergency funds. So life happens, ladies. Miss Tanisha, you work in the death care industry, so do I. We know things happen. When people lose their loved ones, it does take a toll on our finances. So we could have easily used that 6 months reserves to go ahead and fund our investment. But unfortunately, God or Allah or the universe call their loved ones home. And we have to tap into our savings to help our family lay this person to rest and give them a dignified homegoing celebration. And again, life happens. When you're seeing that you're tapping into that 6 months reserves, that is a time for you to halt, for you to wait. So let's go on to the next one. The next one is, and I talked about this in the very first class, your buy, rehab, rent, refinance, and repeat. So, Miss Beverly, you didn't come to the first one, and that's okay. That's why this slide is here for us to go over that with you to let you know what that means. So, the buy, rehab, rent, refinance, and repeat simply it's an investor's engine, Miss Beverly, for building a portfolio using the same capital repeatedly instead of deploying fresh cash every time you recycle equity, and the strategy compounds with each cycle. So you're buying a distressed property. A distressed property means a property that is close to foreclosure, or the property is under the market, or it needs severe rehabbing. Those are what's called distressed properties. And usually when a property is distressed, it's discounted at a significant amount. It is not listed at a fair market. Fair market means if the property doesn't need any rehabilitation, no repairs, it doesn't need to be touched. You go in there, it's in move-in condition, and you can go ahead and list it. The person put a contract in, close 7 days later, they can move in without having to do anything. If the inspection comes out clean, the property is not distressed. Now, when the property needs a lot of work, roof, electrical, plumbing, foundational, there's liens on the property. Those are what's considered distressed. Now,
Mhm.
rehab. You want to say something, Ms. Bev?
No, no, I'm just shaking my head. Okay.
Okay, okay. All right. Rehabilitation, just what I said earlier, when the property needs significant amount of rehabilitation, repairs, if it needs to be repaired, all those things that I said, plumbing, structural, roofing, electrical, those things need to be done in order to increase the value because even though the house might be worth $500,000, but if it needs $200,000 worth of work, that house is only worth 300,000 because I now have to put in $300,000 worth of work on that property. Now, if you should ever run into a property like that and the seller thinks you don't know a lot, you could hire your contractor, which we're going to talk about in a little bit, and you can have them do an overview of the house and tell you exactly what needs to be repaired, put it in a report and say, hey, my contractor came into the house and saw it, and this is what needs to be done. And if and you can take that value and subtract it from what the value of the house is worth, that is considered a distressed property. Next up is your rent. The rent is what qualifies the tenants to live into that property, and that's what generates your cash flow. That's what gives you extra income aside from if you have a 9 to 5, if you have a business going on. This is extra income in addition to the rent. Now, so after you have your tenants living in that property for some time, you go ahead and you refinance the property and you do the whole process all over again. Now, now when you're doing this, you will have experience because you've already refinanced before. So you decide whether or not you want to do a cash out refinance, which again is a large sum of money. It does reset the loan to either to 30 years. However, lenders are doing flex terms where you could do 25, 24, 26, or 27 years. And then once you do that, you take the from the cash out. If you should find a really good deal, I would definitely take that lump sum and pay that property cash because then now you no longer have to pay a mortgage and you're just only responsible for your taxes. If you want your liability, your insurance. Now, I would suggest getting landlord insurance because in the event that something happens to the property, we live in a flood state. The house is located in a flood zone, and the house gets completely flooded. You can make a claim, and they can go ahead and send you the funds to rehab that property, so you can go ahead and put it on the market. Now, you do have another option to doing a HELOC. Most folks will do a HELOC if they know that their interest rate is somewhere between 2% and 4%. If your interest rate is between 2% and 4%, do not do a cash out refinance because you are subject to to today's interest rate, which is anywhere between 5% to 7% when you had a 2 to 4% interest rate. You want to do a HELOC to preserve your current interest rate, and you could do the HELOC. You only take what you need. You do not have to take the entire amount of your equity. You can save it for a later time for emergency purposes. You can use that. You could draw what you need, so you can use that as a down payment. And the last step is to repeat the whole process. So once you repeat that process, you have a system going, and you ladies can have multiple investment properties just using this formula. Make sense? Does anybody have any questions? No questions? Okay, let's move forward. All right. So the next one, turning your primary home into a rental property. One of the most powerful yet underused moves is for women building their wealth is converting their primary residence into a rental property when they're ready to move. So your existing equity, the existing equity in this property, and it's also built into your mortgage, is already in place and it's there for you to use that as a tool, as an instrument for the next property. So let me go over this 4 steps with you. So you want to definitely research comparable rents in your neighborhood. Your rent should comfortably exceed your PITI, which is the principal, interest, taxes, insurance, and some cases your association dues by at least 20% to be holding to be worth holding. So when I say you want to research your comparable rents, you want to see what the rent is going for in your neighborhood. If you see that the rent in your neighborhood is going beyond 20%, that's when you go ahead and make your move. But if you see that you're only gonna like generate just $50, $100, then you might want to just wait for a moment and just kind of see, wait a little bit, maybe another 6 months to see how the market is before you make that move. Now, how to check your comparable rents? You want to check the square footage of your home. You want to check the number of bedrooms versus the bathrooms, the amenities that your property has. Does the property have a pool? Does it have a patio? Where is it located? Does it have just a view of the neighborhood? Does it have a view of the lake? Is it in a cul-de-sac where there's not a whole lot of access? So those are the things that you want to look at to deem as comparable to your home, your property. Next up is you want to notify your lender or your insurer. So if you do see that the rent in your neighborhood exceeds 20% of what you're currently paying on your mortgage, which again is your principal, interest, taxes, and insurance, you want to go ahead and get a rental policy. Rental policies are a lot cheaper, ladies, than your current policies. So that could actually make your mortgage go down a lot lower. Now, when you do that, it might trigger the home, your lender. Hey, she's getting a rental policy because she's renting it out. So that might trigger them. So you might have to let them know, hey, I'm renting this property out. Now, if you're doing a conventional loan, there it may not notify the lender. However, with FHA loans, it might do, and they might ask you, "Hey, are you doing this?" And there's a possibility they in the last course that we talked about, they might ask for a due on sale, meaning they want the balance. So it really depends on your lender. You might want to you can talk to me and I can give you more information on how that might work if you have an FHA versus a conventional loan or if you have a VA loan, which I don't think you two ladies have that. Next up is prepare the property. You want to make improvements to the property to maximize the rent. So if you see that the walls might need a new fresh paint or it might need new fixtures like lighting fixtures, you might want to give the landscape a little bit of love. You don't want to over improve it, which is called a functional obsolescence. When you over improve it, even though you might have you tricked out the house like $100,000, if the market says that the neighborhood is going for max $3,000 and you feel that you should get $5,000, that's what the market is going for. That's what people are paying to live into that neighborhood. So you do not want to go above and beyond in tricking out this house, meaning putting smart refrigerators, and you don't want to put like custom marble from Morocco when you can just get granite or formica for, presentation purposes. So do not over improve on the property because even though you think that the house is worth $5,000, people are just going to go whatever the market is going for, which could be anywhere between $2,000 to $3,000. The next thing, you want to screen your tenants rigorously. I cannot
Yeah.
stress that enough because let's say that you ladies say, you know what, I don't need to use a real estate investor. I'm going to do this on my own. And that's okay. That's what this class is for. I'm not here to hide or gatekeep any information. The things that you want to look for, ladies, ask these people for the last three pay stubs. You want to look at their year to dates. You want to look at their hourly, Are they getting paid for 40 hours a week? Does it fluctuate between 30 to 35 hours? You want to look at those things. You want to look at their credit scores. The credit scores tell you straight up how often, how likely do they pay their creditors. If they can't pay their creditors, they won't pay you on time. That's the bottom line. That's the simplicity of it. If they're paying their creditors 30, 40, 30, 60, 90 days late, what's the likelihood that they're going to pay you on time? So that's the things that you want to look at. Look at every single liability. And if they protest it, ladies, then that's a red flag. That's a total red flag. You want to get you want to check with their previous landlord. Hey, would you rent to this person again? And you want to make sure because people have gotten smarter in the years that they can get their family members to check
Mhm.
to talk on their behalf. You want to go on Miami-Dade property search or Miami-Dade or Broward County property appraisers and see what the name of the landlord is and do a true search. Search them up because if you do a due diligence search, you can probably find them and their cell phone numbers. And if it matches the application, perfect. You can go ahead and call them and ask them questions that are not incriminating to your potential tenant. And if the numbers doesn't match, then you know what time it is. They were just trying to throw an okey doke on you. So you definitely want to do a very, very comprehensive background check on your tenants because these are the people that's going to be paying your mortgage. And if you don't pay your mortgage on time, you can't do this process again and again. Because in the last couple of classes, all it takes is just one missed payment and you cannot do another refinance or a HELOC. So you definitely want to do your due diligence. If you have questions on that, I'm here. You both have my phone numbers. You can call me and I'm happy to tell you what to do to protect yourselves. So let's move forward. So the
But
next,
quick question, from the companies, you can hire rental companies to do all of that for you, so you're not getting
yeah,
involved,
yes, ma'am.
and they do all the verification and checks.
Yes, they do all the verification checks for you. They do the background checks. They do even police background checks to see if they have any felonies because you don't want to harbor felonies in your home because let's
Mm.
say you go to pick up your rent and they want to try to shank you. Yeah. I mean,
Okay.
yeah, we're strong and independent, but hey, I know my limitations.
Yeah.
Okay, so now we're going to talk about short-term versus long-term rental strategy. So not all rental income is created equal. The right strategy depends on your market, your risk tolerance, your available time, your financial goals. Both can be exceptionally profitable, but they require different management approaches. So I'm going to talk about your short term. So your short term is your Airbnb and your Virgo. So those
Mm.
are high income variable. So this can actually maximize your returns, but it requires, hello, Miss Anya. Thank you for joining us. We are talking about short term and long term rental strategies. So with short term rentals, those are typically your Airbnb, your verbos. So those will give you high income. They may fluctuate, but those can give you a lot of maximum returns. And this does require a lot of effort. When I say it requires a lot of effort, because okay, so with these type of properties, these are comparable to hotels. So you want to give them everything that they want so they do not go to a hotel. Oh, let me
Mhm.
see what she says. Oh, that's okay. Better late than never, Miss Anya. So,
Mhm.
okay, so with the Airbnbs and your Verbos, they can generate a lot of money every single day. Like 1 month's rent. I mean, sorry, 1 month's rent could be actually generated in just a matter of couple of days, depending on your property. So yes, they do require a lot of effort because you want to give them the amenities that they could have gotten at a hotel, but they don't have to deal with the red tape of a hotel. They don't have to deal with when they check in, the hotel takes, a
Credit card deposit.
exactly, a credit card deposit where they're paying three, $400,000 as a hold on their credit card, and they have to use a totally different credit card to go and enjoy the sights here in South Florida. Now, the next one is the active management, the daily operations, a constant oversight. So,
Mhm.
when you have a property that is being Airbnb'd, it's a shorter period of time. So they're spending probably like 3 to 7 days. So when they're spending 3 to 7 days, they could call you and say, "Hey, this is not working." So you're on call for those days that they're there. And then when they're gone after those days, you now have to turn over the property. Everybody doesn't have the same cleanliness as you, Miss Anya. They may not be like completely sanitized where they bleach everything, they clean behind them. They could be like, well, hey, I'm staying here. I'm paying a cleaning fee, so that's what I'm paying for. They go ahead and clean that. So depending on their cleanliness, you got to go behind them and clean that place and make it sure that that place is spotless and sanitized for the next person
Mhm.
that's going to come the next day or two. So that's the effort that I'm talking about. The next thing is regulations vary. So when I say tourism and urban hubs, so where's this property located? Is it 10 minutes from the beach? We live in South Florida, ladies. We people come here because of the beach. Whether we go there, they don't come here for our feelings. They come here because they're leaving the yes, Miss Beverly, they're leaving the cold
Mhm.
weather in Pontiac, Michigan. It was 47 degrees. We have 80 degrees weather all April long. If we're not
Mhm.
working on Saturday, we can choose to go to the beach. They don't have
Mhm.
those luxuries. So where's the property located? Is it 10 minutes from the beach, 5 minutes, 30 minutes? So we have to be mindful of that. So if you know your property is five minutes from the beach, that could easily be an Airbnb versus a long-term rental. Now, regulations. Now, some cities, I know the city of North Miami Beach, they're funny about Airbnbs. It's weird, it's your property, but hey, they feel like, well, we should step in and tell you how you should regulate your Airbnb. So those are the things that you want to look at. And if you hire myself as your realtor, I can look into those regulations for you and tell you, hey, the city of Lighthouse Point is telling you this. The city of Hollywood Beach is telling you this. Dania Beach is telling you this. So you want to look into that because that totally plays a factor in your rental, whether it's going to be short term or long term. So let's go ahead and take a look at your long term rentals. Long term rentals, we know, is stable monthly income. You know what you're going to get every single month for the next year because your tenant is locked in a lease. They're in a lease agreement unless, God forbid, something happens that they lose their job or they lose their life partner or spouse that was helping them contribute to the rent. But at least we know if none of those factors occur, we know how much we're going to get for the next 12 months. Even if the rent is late, we know that there's a late fee on top of the income that we're going to generate for the next 12 months. Lower intensity. So that means we don't have to oversee these properties every couple of days like an Airbnb. Usually, if the house is in good condition and you hire a you rent the property to a responsible tenant, more than likely they're not going to call you. If you provided them new appliances or newer appliances, functional appliances, they're not going to call you unless they are irresponsible and they don't know what they're doing and they break everything that they touch. For the most part, the intensity is going to be low. The next thing is you don't have as many periodic checks as you would have had an Airbnb that you would have had to go every few days after the person leaves to turn over the space for the next person that's going to rent the Airbnb for the next couple of days. if the property is in a suburb, we know that this is away from the noise, this is away from partiers, this is away from tourists who's looking to have a good time. These are your regular folks who are your locals, your natives that live in the neighborhood. They know the area. They just using this place to, as their habitat. They get up in the morning, they go to work, and they come back home. This is not for your tourist that is visiting the city. Does anybody have any questions before I move forward?
I do about the Airbnb.
Okay.
Isn't Airbnb, you're saying it's maximize income, but isn't someone getting a percentage of the income? You're not the one renting it out yourself, right? It
Well,
goes through,
I'm sorry. Go ahead. Go ahead.
no, but does it go through someone and then you get the income, or are you being paid directly from the people,
Okay.
the clients?
So you have two, and thank you for saying that. So you have two ways of doing the Airbnb. Now, Airbnb and Verbo, yes, they're going to take a percentage from off the top, and then they're going to go ahead and give you your funds. Now, if you understand the process of Airbnb and Verbo, you can actually do it yourself. So
Okay.
you can actually do it yourself in the point that if you rent out your unit enough to people and say, hey, here's my contact information that has a QR code that they can scan, and you create a website on your own that they can actually make reservations since stay in your unit. You can actually do this whole process yourself and not have to give a commission to companies like Airbnb and Vrbo. However, if you're just
Um,
starting out, then yes, use them, see how their process works, and
then you can move
and
from this side from there.
there
Got it.
you go.
Okay, that was good
There
information.
you go. I didn't want to say that in case somebody come back and sue me. So yeah,
Yeah,
go ahead and
yeah, I
see
got
what
it.
there you go. So yeah. So with this the long-term rental, you actually have stable income for the next 12 months. You know what you're going to get paid, when it's going to get paid, and if you know that the rent is going to be late, they have a window that they're going to pay the rent plus your late fee on top of it. You know all the
Mhm.
terms and conditions of your long-term rental. If you know that you're going to have the property in a suburb, you know that it's most likely locals that live in the neighborhood. They know the neighborhood. They're renting from you for habitat purposes, and these are mostly families. Okay? All right, let's go ahead and move forward. Now, house hacking for women. House hacking, what exactly does that mean? In the very first class that I taught, I told you, beautiful ladies, that house hacking is if you find let's say a duplex, a triplex, a quadruplex, a fiveplex, and you live in one of those units, and you rent out the rest, one of your tenants can actually pay your mortgage off and you're living rent free. Yes. And then let's say you have a fourplex. The other two units is passive income, cash flow that you can use whether to spend on something else, to build up your reserve for your next property, or just to have money there as operating costs in the event that something might happen later on and you need those emergency funds to fix any of the units. So that's what is house hacking for women. And it's such a powerful tool. It's such a powerful instrument because if you do it right, you can live for free. Because in this society, you're always going to find somebody that needs a place to rent. Everyone does not have good credit. People like to flex. And to flex, it costs a lot. It might cost having not so great credit. So everyone does not have the right financial mindset. So someone is always going to need to rent. So let's get into the housing hack for women. So the duplex play. So if you purchase or you already own a duplex, as I just mentioned, you live in one and you rent the other unit. Your tenant, your tenant's rent will offset what your current mortgage is, and sometimes it eliminates the entire mortgage where you don't have to pay for anything, and then your mortgage payment is entirely and paid for free by the other tenant. Now, an ADU, which stands for additional dwelling unit or garage conversion. So if you have what's like we call it efficiency in the backyard, you can actually rent those units out. Some people rent it back in the days, it used to be $800. Now it's $1,000 or more. Not even 1,000, $1,100 or more. Some of these ADUs or additional dwelling units, they're very sophisticated. They have um, stove, ovens, smart refrigerators, and dishwashers. And the space is ample enough to have a bedroom set and living room. So if you ladies have additional units in the back, you can definitely maximize that in getting rent off of that. And if you have a garage that you're not using at all, and you, let's say you are perfectly fine using the driveway to park your car, you can definitely convert that garage into an ADU. Make sure, though, I want to definitely point out, make sure that you pull permits, because in the event that you decide that you want to sell that unit, you want to make sure that that garage conversion is factored into the price of your list price. Because if you don't have any permits, you're only subject to whatever tax records says your property is. So let's say you have a 3 bedroom, 2 bath, and then you decided to convert that the garage into an ADU, and you didn't pull permits, if the buyer is smart enough, or the realtor will tell you, hey, well, you don't have any permits on this property. Your property, the comparables in your in the neighborhood is saying that your house is only worth $450,000 when you thought that your house was worth 525. And if you don't have any permits, excuse me, that's an argument that they can make. So you definitely, if you're going to convert your garage into an additional dwelling unit, make sure you have permits on the garage. Next up is room by room rental. That is a popular thing now. People are renting the rooms out. Like, let's say that you living in this big house by yourself. You're not married. You're an empty nester, and all your kids have grown up and gone to college and gone their own ways. And you're like, dang, I don't want to live in this house by myself. What can I do? You can rent out each and every room that is vacant, and you do what we just talked about in the previous slides. You do a rigorous tenant background search. You check their criminal, your credit. You ask for the last 3 pay stubs. You ask for the previous tenant number to get a reference from them. You match the number. You do a true people search to the landlord that they currently had prior to them moving in with you, to make sure that it matched, that you're not talking to their cousin, their aunt, or their boyfriend. Because again, some tenants are very smart and they know how to get over the system, and you want to protect yourself. Next up is your short-term room rental. So there's some people who live in the house and they rent an extra room out. We don't have basements in South Florida. I know in some parts of Miami Gardens, there are basements, but there's some people who have extra rooms out that they don't mind to rent it out, Airbnb or short term, if you know what you're doing. So that's a definite extra source of income. Surprisingly enough, some short-term tenants, they will rent out their unit for, weeks at a time, because they haven't solidified a permanent residence. So sometimes they'll rent the place out for you for, 2 weeks, 3 weeks, 4 weeks at a time. And that's income. And that income can offset your mortgage, you know? So those are some of the 4 housing hacks for you, beautiful ladies. So let's move on. Your risk mitigation versus and your reserves. So scaling without a safety net is speculation and not a strategy. The whole point of these classes is to be strategic in being investors. So the investors who sustain long-term wealth through any market cycle, numerous amounts of vacancies, unexplained repairs, are those who build risk management every deal from day one. So your reserve framework is your emergency reserves. So reserves is the money that you have saved up. I don't know, you guys, I'm going to say this now. You want to create an operating expense account. So basically, you're just going to your bank, whoever you bank with, and say, hey, I want to open up a separate bank account. If you do not have an LLC, we talked about this in the previous class. You can just say, hey, I want to open up another savings account or checking account. And you just, every time the tenant pays your rent, you dock the rent and you put the remainder into the operating account. Or if you paid the house off, you God blessed you and you were able to pay the house in cash and all you have left is your taxes, you can just put the rent into this aggregate account that is just sitting there, that in the event that something happens, you have 6 months of emergency funds in the event that something happens. God forbid you get hurt, the tenant, sorry, life happens, the tenant dies, and you still got to make these mortgage payments until you find your next tenant, or the tenant says, hey, I'm getting married and we decided we want to create a life together and we're going to go buy a house together. And I'm so sorry, I'm going to go ahead and break this lease, but hey, I'm still going to pay you the penalty fee. Yes, they pay you your penalty fee, but you're out of monthly rent for the next couple of months until you find somebody. So you definitely want to build up the 6 months rent. Next up is your property reserve. So aside from the 6 months rent, you want to have at least 3 months of your principal, interest, taxes, and insurance to be held in a dedicated account. So now that's another account. That's another account because God forbid something happens, even though you have this 6 months emergency fund that we're not touching for any lifestyle enhancements or vacationing. This money is just sitting there, so we make sure we don't touch it just in case the roof collapse, the house gets completely flooded because knock on wood, we have a terrible hurricane season. We live in South Florida. Anything can happen in this place. Next up is your capital reserve. Your capital reserve. So your capital reserve is the money that you need for roof, your AC, your electrical, and your appliances. You want to make sure that you set aside 5% of your rent just for appliances. And then last but not least, your vacancy reserve. You want to at least budget at least 1 to 2 months of vacancy per property. When I say per property, let's say you ladies had an amazing year, and I follow up with you and you say, Kathleen, girl, I got 4 properties underneath my belt. Girl, I got 3, I got 2, I got 5. So for each of those properties, you want to at least have 1 to 2 months of reserves in the event that something happens. That same girlfriend that I told you about, who did the process of um, buy, rehab, refinance, rent, and repeat, she had a tenant that moved in, and because the person above them had a special needs child that was making a lot of noise, they said, listen, Miss Lorraine, I can't deal with the noise. I gotta go. I work 10-hour days. I need my break. I need my peace. I can't deal with the noise. And people, they bail because let's face it, we all work hard hours. Miss Anya, I know you work in the medical field, so you work 10 to 12 hour shift. Miss Beverly, you out hustling. You're just like me. You're in sales, and sales
Mhm.
is a mental game, and it's mentally exhausting. And Miss Tanisha, you work in a business that is emotionally taxing. We need our peace of mind. So sometimes things happen where we may not jive with the neighbor next to us, that it's too much noise. And I gotta sleep. I gotta wake up and do this all over again. I can't take it. So I'm breaking my lease and I'm gonna live elsewhere. And that happens. So when these type of forecasts take place, you definitely need to have money set aside just in case those things happen, so you are ready for those circumstances. Let's pray and pray to God, pray to Allah, pray to the universe that it doesn't happen, but it does. Risk
Mhm.
risk reduction strategies. When I talk about your LTV, that's your loan to value. the loan amount versus the value of the property, you never want to take more than 80% of the LTV because you still need that 20% cushion. You want to do a stress test. So your stress, I'm going to go over that with you, ladies, what the stress test is. So your stress test, because I want you to completely understand what that means. So your stress test is this. So let me go over that with you. Your stress test. All right, so it's a calculation that I had did for you ladies, and I had it all laid out, but you know, technology, yay. I did a stress test for you guys. Okay. Uh, okay, stress test. Let's do it. Okay. Okay, let's do it. So, all right. Oh. All right, so your stress test basically it tests a percentage. Hold on a second. I had all of this ready for you, so okay, hold on. I'm almost there. Okay, here we go. All right. So here is how the stress test works. So you want to take your okay. So with the stress test, you want to take what all your you want to take your all right, so you have you can, like Miss Beverly asked, can I just have somebody else manage the place for me in my behalf? You can do that or you can do it yourself. So you want to take whatever they're charging you to rent to manage the place. You want to take your taxes, your insurance, and in some cases your association, and you want to also take your you want to take your mortgage, which is your principal, interest, taxes, and insurance into account. And the if you see that you want to see what that number is, and if you want to take 10% of that amount times 12, and then you subtract it by 10%, that's what you might lose for the entire year in rent. And if you see that your expenses is higher than amount, so let's say that the property is worth $150,000. We take 10% of that, that's $1,350. So that is what we know we could possibly lose for the entire year in the property being vacant. If you see that your expenses is 20% higher than that $1,350, then you don't move forward the property, even if you think, damn, that property is located in a good area. If you see that your expenses is higher than that, that's going to be a telltale sign that you will always experience paying double, losing double that amount, the 10%, the $1,350. So you're going to lose what, $2,700 every month, I mean, every year. So that's what the stress test tells us. So you want to make sure that your expenses is either 10%, which is which will wash out the 10%, but no more than that. The next one is use fixed financing wherever possible to eliminate rate risk. So as I mentioned with you ladies earlier, with HELOCs, HELOCs are tied to the market, so it fluctuates every single month. One month it might be 7%, the next month it might be 9%, but it's very pertinent that you have an exit strategy. Do you plan on paying this HELOC sooner than later? If you're not, then it's best to get a cash out refi. You want to diversify your properties, meaning you don't want to stick to one particular market area. There's lots of different market areas, lots of different um, um, property types, whether it is condos, whether it is single families, duplexes, triplexes, quadruplexes, 5 to 8 units, low-rise apartments. You want to maximize every market area because people live everywhere. We don't all live in the same area. Like I live in North Miami Beach. Tanisha lives in Miramar. Miss Beverly might live in Pembroke Pines. Miss Anya might live in North Miami. There's renters live everywhere. There's not one cookie cutter. Next up is you want to maintain landlord insurance with umbrella liability policy on all your properties. As I mentioned to you before, landlord insurance is a lot cheaper than your regular insurance because you're not occupying that space, but you want to make sure you have liability in the event that you might lose to supplement for your rental loss. You might want to have that in the event that something happens to the property due to damages. Um, the roof falls off. Uh, God forbid a tornado comes. South Florida, we make the news for everything. So anything is possible in this area. Next up, you want to build your team. Before you get into this market, you want to have a CPA to do your taxes. When you have a CPA to do your taxes, that person can claim all of your properties in your taxes and do it correctly. You want to have an attorney to protect you from lawsuits because these days people are always looking to sue you. You want to, hire an attorney to structure your corporation or your LLC properly. So in the event, like we use an example, I think either it was last week or the week before, God forbid the roof collapses on somebody and they're looking they're looking for to sue you. The property shield the business structure shields you from them coming after you for your assets, coming after you for money, coming after you for the property. Because if all of the properties, the 9 properties that you have are under the corporation, I don't own anything. I don't own nothing. Pristine Green Investments own all my properties. I don't own nothing. And they have to go through the courts with that. You want to hire an inspector who knows what they're doing. So when you are looking at investments, they're looking at every single thing. They're going through crawl spaces to see if there's any foundational issues. They're checking your plumbing. They're checking the PVC pipes. They're checking your electrical panels. Is it this close from getting burning out? And then the property needs to be wired all over again. That is a very, very costly process. They're looking, how many years are left on the roof? The roofs are not expensive. And then you definitely want to get a contractor because the contractor will tell you, hey, okay, I can see potential of you building out an additional unit to this to generate more income. So you definitely want to have them structure this team before you need them because God forbid something happens, you don't want to vet strangers when you're in the midst of a storm. Next up is your building a 3 property portfolio. So, ladies, you want to max out your equity in your property. What I mean by maxing out, you want to make sure you pay enough or more into your principal, because the more you pay into your mortgage, the more you build up your equity. You want to pay down your debt. In the previous sessions, we talked about keeping our debt utilization below 30%. And as an investor, ladies, you want to keep it down to 10%. 10% because you want your DTI, your debt to income ratio, to be low as possible. The lower, the better. Even though I told you in previous classes that 50 is the max, you want to be at 47, because that's really what the automatic desktop underwriter likes to see is 47. They don't like to see 50, because you're bucking it with your debt. You want to get pre-approved for an investment property without having to just wing it. You want to know what you're truly qualified for. You need to know your numbers down pat. You need to know that, okay, if I go look at this low-rise apartment, this is what I can afford. This is what my credit score, this is what my lender told me that I would have to put down if I decided I wanted to buy a 12-unit apartment building. You need to know this. You cannot go into things blind. Next up is your first rental. You need to know whether you're going to use a HELOC or a cash out refi for your down payment. If you're going to do a cash out refi, remember it's a lump sum. In some cases, you can use that lump sum to buy something cash outright. But if we're going to buy this low rise apartment building, then we know that that's going to be enough capital to put down on our down payment. And we can do the rest as a DSCR. In the previous class, the DSCR only goes by the rental income and not your personal income, because God forbid something happened and that you had to go on a sabbatical because you tore your rotator cuff and you can't work for X amount of years. Number two is a property going to be a cash flowing long-term property in a stable market, or are we doing a short-term rental where we know that we're only renting a couple of days at a time, or we might have 4 days out of the month that is vacant. So those are things that we need to know. Are we converting our primary home into a rental, or are we buying new? So those are things that we need to know ahead of time before we get into the market. Next up, we need to optimize. What does that mean by optimizing? We need to build enough equity so we can use that equity to do the formula that we talked about. We're going to buy, we're going to rehabilitate, we're going to rent, we're going to refinance, and we're going to repeat the whole process. The more equity we have in the properties, the more we can continue with that formula. If we do not have enough equity, then that means we have to use our savings to get into that. If we do not have to tap into our equity for emergency purposes, um, we need to pay our mortgages on time. The mortgage company gives you a set period of time that you can pay your mortgage. We cannot go over 1 day late, because that will jeopardize us from getting our refinance to buy our next property. Another thing, we need to deploy equity from our growing portfolio into a third property. So let's say we already have two properties, but oh my God, we found this beautiful, let me not say beautiful, because I said in the very first class to take the emotion out, because we're not buying on aesthetics, we're buying on location, we're buying on economic growth, we're buying on trends, and we're buying on functionality. So we find this property that meets all of those four requirements. It's a 12 unit. Oh my God. I can rent this property for $1,000 each, and my mortgage is only $3,000. Oh my God. I just made 13. I have $9,000 in profit. So we have to make sure that we have enough equity in in our first two properties, in case we can pull the money out for that to be our down payment on our 12-unit apartment building that's going to generate us $9,000. I'm only saying $9,000 because it's such an easy number to tell you guys. But we live in South Florida, you can probably rent it out for $1,500, $1,800 or more. So again, the timeline is we want three properties. We want diversified portfolio generating multiple incomes, because in the very first class, it was said that we need more than one income to survive. Somebody said we need at least 14, but we can at least start with three. We want to generate at least $6,000 in monthly rental income combined in gross rent, gross before taxes, insurance, property taxes, but that's the minimum. But let's go for more. And then our timeline is 7 years. 7 years is not a long period of time, ladies. It can go by this quick. And then next up is scaling with discipline. So you're scaling a real estate portfolio is not about moving fast, it's about moving intentionally. When I say intentionally, meaning monitoring our credit scores and our credit history. We want to make sure we don't have any lates. We want to make sure we don't have any late mortgages. We want to scale intentionally with making sure our equity is in place. We have reserves in place in the event that the lender will ask us for that. So investors who build a lasting wealth share one common trait. They say no to most deals so they can say empathetically yes to the right ones. So we want to analyze every single deal on paper first. So you want to run the numbers. You want to run your cash on cash. You run your gross rent multiplier before visiting any single property. Your emotions does not belong in underwriting. I said this before, ladies. We do not look at properties emotionally. We run numbers, we run risk factors. So you might say, what does cash on cash mean? So what it means is, how much am I making on this actual cash that I put in? So the example that I'm going to use is, you put $20,000 on a property. The property generates $2,000 a year in net cash flow after your expenses. So that means you ladies you earned 10% on cash return. So you just netted 20 after you paid all your expenses from that $20,000 down payment, you made a profit of $20,000. So that is your cash on cash. Now, what is my gross rent multiplier? So that is that I'm going to give you an example. So the property costs $150,000 and you rent it out for $1,500, which is 10% of the purchase price. If you take that $1,500, Ms. Beverly, and you multiply it by 12, that's $18,000 for the year. So your gross rent multiplier is 8.3. If it's lower than that, that's good. But investors use this to quickly screen dozens of deals before spending any money. So they make sure that they do these numbers to make sure that the numbers is there. So again, ladies, we do not put emotions in anything. Emotions doesn't, I mean, you only put emotions in property that you know that you're going to live in. You know that you're going to lay your head in. Those are the things that but when it comes to your investment properties, all you care about is the location, the economic growth in that neighborhood. Can I get X amount of money for my rent? You don't put emotions in your investment properties. The next thing is, you want to protect your credit like it's an asset. Ladies, I can't stress this enough. Your credit score is the key to capital. It's the key. Your credit
Mhm.
score can get you into doors that people who have money may not be able to get inside of. So you want to keep, again, your utilization low, your utilization meaning the usage of your credit cards. You're supposed to keep it below 30%, but when you step into the investor arena, we got to keep it below 10%. You want to make sure you pay your credit cards on time, avoid unnecessary credit inquiries because it hits your credit scores, and because each of your property portfolio depends on it. So you got to guard your credit history, your credit score, like it's money or your property. You want to build systems, not just properties. A portfolio of three properties is managed poorly will tire you out. But if you invest in the property management, in case you say, hey, I don't want to do this, and you get a good property manager to manage your property, and you automate it and you process it, you'll be in a good financial standing. You also want to revisit your strategy annually. So every year the market shifts, every quarter the market shifts. So you got to be mindful of how of what's happening in the market area of where your property is located. It's always good to run the numbers quarterly to see how the rental history is going for within a mile or a mile, half a mile of your property. You want to see how the market is the temperature is. Is the market going up? Is it going down? Life changes. You want to review your equity position. You want to see what houses sold for in your neighborhood to see how the equity stacks up against your house. And you want to review your financial goals every year. You don't want to be complacent. You always want to see, what's going on with your financial health, with the market health, and the equity that's in all of your properties. This is my last slide. It's so sad because parting is such sweet sorrow. So before
Mhm.
I give my information, which all of you ladies already have my information, now is your time for question and answers. Let's go. I'm ready. I know you
Okay.
have questions, Tanisha. Oh, no question. Wow. Okay.
My
Then
question was regarding the Airbnb and Verbo because I rented before and I have horrible experiences and I'm like, I'm never doing it again. But this has
wow.
actually opened my eyes, yeah, to looking back at this. But that's why I was asking about management. I don't want to do it. I want it to be handled by the management company.
Okay.
So that's something that I was looking into. While great presentation, by the way. I got a lot of information
Thank
on my
you.
notepad.
Thank you. Thank you. Thank you. Thank you. So, can you share with us with the class what your experience was like with the Airbnb?
Well,
The
I no, I didn't have an Airbnb. Are you talking to me?
Yes, you, Miss Beverly.
I've never had an Airbnb. I've had my home that I moved away from when I moved out of that state, and we rented it to some family members, and it not even family members, just people, and they didn't take care of the home and it made it a mess, and it was just horrible. It was hard to get them out. And then when also came to Florida and moved out of my townhome and moved into this house, the same thing. The tenants wanted to buy the house. They were horrible, horrible. So
So what
that
did
scarred me.
what did you do to eventually get them out?
So they wanted to buy the house and they weren't able to afford it. And at that time, and I could kick myself many times, that's when they were having the loan forgiveness program back in 2010 when the homes were upside down.
Yeah.
So I did that, whatever it's called. I forgot what it's called, but the forgiveness program. So I was able to walk away from it.
Okay. Oh, wow.
Yeah.
Okay.
And now when I look, the home is worth double what it was. So yeah,
Yikes.
couple
Yeah.
experiences, but I stay away from it.
Yeah, so yeah, there's management companies that will manage the property for you. They will turn the property over. They have their housekeepers, they have their
Yeah.
plumbers, electricians, they have all of those people to go ahead and fix it and get it ready for the next person if you don't want to deal with that. But yeah, like if you have a property that's just minutes away from the beach, that's easy because people don't like the restrictions of hotels. And they
Yeah.
just like the freedom of not having someone next to them that have to worry about noise levels and stuff like that. So if you end up finding a good deal, a good property that is near the beach, because this is where people come, they come here for the weather. They don't come here for us. They come here for the weather and the beaches. That is definitely, a good opportunity to rent it out short term. Um,
Yeah.
Anna, did you have any questions that you want to ask or no? Let me see.
Mm, no.
No question? Okay. Okay.
I was a little bit late, so I can really ask question.
No problem, no problem. So I'm gonna send you the playback so you can listen to it. So the next class we're gonna talk about the structuring of your business and the legalities of it. So you guys, ladies, know that for next year, not next year. So when you do buy your property, and let's say that you buy it underneath your name, you can actually you can actually, you want to know how to structure it so that if you should transition, you should pass away, you know the legalities of who you should leave it to.
Mhm.
And they don't have, no, none of your kids, if you have kids, have to put up a fight to you with probate and stuff like that. So before I let you go, and I'm so pleased that you ladies have, dedicated your time to being here and receiving this information. As I mentioned last week, I have another event coming up in May. This one is called Keys and Cocktail. It's a buyer's happy hour. Basically, let me show you this event. Where is it? This event is just an event to let your hair down and just enjoy yourself. Any this is not really like a classroom setting. It's like a game night. So you can have fun, you can network. There's going to be refreshments, there's going to be food, there's going to be adult beverages, and if you don't partake in adult beverages, there'll be other non adult beverages. So I'm gonna show you the link,
How
the
many people can be invited?
as many people as you like. Let me share my screen with you. And I'm gonna put the link in the event. So yeah, this is a free event. Any as many people as you want can be invited to this event. It's going to be at the Total Wine in Aventura on a Saturday. It's a Sunday. Oh, wait, a Sunday? I'm going to double check that. But it's supposed to be really a Saturday from 4 to 9. Sorry, 4 to 6. But sometimes they'll let us go over. We're going to play like games and there's going to be prizes and I like to have a good time. So if any of you guys have hung out with me, I like to have a good time. I like to have a really good time. So I'm going to drop this in the link and I'll email this to you ladies. So if you decide that you would like to go, please feel free to register. This is a free event. This is I haven't really never seen any kids inside of there. I can ask them if they allow kids inside, but yeah, feel free to come. You know, it's a fun event. Again, we're gonna play games. We're gonna get into teams. We're gonna give prizes away, and there's food and drinks, and it's a Saturday. So I hope that you ladies can make it. So if you don't have any other questions, I'm gonna let you go because I know we ran a little late, and I will send you ladies the replay to your text messages of tonight's event.
Okay, sounds good. Yeah.
All right?
Yeah, I may be calling you soon, Kathleen, because I do have someone I want to see how you can work with them and what would be needed.
Okay, sounds
Um,
great. Thank you so much.
yes.
All right, ladies, thank you so much for being here. I appreciate you. Thank you, thank you, thank you.
You're welcome. Thank you.
You're so welcome.
Okay.
All right,
Bye bye.
bye.